Welcome to Supernatural Stocks on Moneyweb with your host, the Finance Ghost. This is your weekly fix of equity analysis designed for stock pickers. Whether local or international, you can expect a mix of news and my ideas about what I'm seeing in the markets. Is it a bird? Is it a plane? Perhaps most importantly, is it a bear market? When investors have gotten so used to incredible returns from equity markets, seeing the Nasdaq and the S&P 500 in the red year to date is quite a shock. But just how bad is it, and what are some of the important strategies to think about in a time like this? Firstly, let's be clear here. This isn't really a bear market. Not yet, anyway. A bear market is generally seen as a market in which prices are down more than 20%. Some definitions simply refer to declining prices and pessimistic market sentiment, but on the whole, with the S&P still up 9% over 12 months and down only 4% year to date, calling this a bear market feels a bit like a stretch. Even if we compare the current level to the 52-week high, the S&P 500 is down 8.4%. Annoying, but hardly a disaster. If we do the Nasdaq 100 instead, we find a return of 9% over 12 months, very similar to the S&P 500. The year-to-date decline, 6%. The decline from 52-week highs, 11.5%. More volatile than the S&P 500, as one would expect, but also not by much. The technology names really do dominate both indices, and that's why the performance converges. But again, it's not a bear market. Right now, I think we can agree that this is a scare market, a term that I kind of came up with for this podcast, and a quick Google suggests that it's not widely used, so I'm going to claim it as my own, and let me know if you like it. We've seen a market correction off the back of a major geopolitical shift in the world, and yes, stocks are down, but they're not down by a huge amount. Having said that, you might feel differently if you dabble in small caps. The Russell 2000 index in the US is a great proxy for the market beyond just the big names. It's now flat over 12 months. It's down 8.7% year to date, and it's down nearly 17% off the 52-week highs. A scare market in the big names tends to lead to a bear market in the small names. This leads us directly to our first scare market strategy. Be very careful of small caps. Small caps are just eternal heartbreakers. They trade at structurally lower multiples than the large caps, as there is literally something known as a size discount in the market. This is the result of investors being more nervous of small companies than large companies. Let's call a spade here. Microsoft is far less likely to go bankrupt than a small software as a service company. There's a genuine risk differential here, so it is 100% incorrect to point to a small cap and say, hey, this is a similar business model to Microsoft, and yet it trades on a multiple that is 5 times lower. Big opportunity here. Not necessarily. When investors panic, they panic here first, in small cap land. You've probably heard the terms risk on and risk off before. If you haven't experienced them yourself, just add some small caps to your portfolio and watch them over time. Even though they trade at cheap multiples, firmly in inverted commas, cheap can get cheaper. And it usually does when there's a scare market further up. When investors in big names are licking their wounds, you're 6 feet under in small caps. Risky stocks are for risk-on markets, and we are not in a risk-on market right now. The second strategy that I would like to put forward is to not do your best research when you are 10% down. This was one of the best things I read on Twitter, as it was called at the time, now X of course, during that first post-COVID rout in tech stocks. It went something along the lines of, I do my best research when I'm 10% down, and people just loved it and retweeted it and everything else. And it was a nod to how many investors buy the dip without actually doing the work. As the dip keeps on dipping, they finally put some effort into understanding the stock. By then, they are sitting with a long position that they probably shouldn't have. How do you mitigate this risk? Well, I think you build a watch list and you only buy dips where you've done the work to assess whether you've reached a proper entry point yet. For example, if a company is trading on an earnings multiple of 20x and its average over a decent period of time is 15x, then you can make a pretty compelling argument that the multiple is 33% too high. Sure, if there are great reasons to believe in the future and something has changed in the business model, then it can stay 33% too high. But when the music stops and risk off is the nature of the game, that multiple almost certainly will unwind. At what point then does it become appealing? I would argue that buying at a multiple above the historical average in a falling market is a really good way to be the proud owner of a stock that keeps on dipping. If you've done the research, though, to assess the historical average multiple and you've compared it to the current prospects of the business, you're in a much better position to have discipline around your entry price and to feel better if you've bought it and it keeps on dipping, because perhaps you're really happy with the price you bought it at anyway, and in fact the subsequent dips are even more of an opportunity. Discipline and research lead to better outcomes in a scare market, and especially in a bear market. The third strategy that I would like to put forward is to learn something from traders. My pet hate, or at least one of my pet hates in the market, is listening to traders talk about how fundamentals don't matter, or listening to investors talk about how technical indicators are just a waste of time, some hocus pocus. It's just so silly for me. The market is full of both types of people, and the price is always going to be a reflection of how buyers and sellers interact. So what on earth is the point then of ignoring how a big portion of the market thinks? If the market always behaved according to finance textbooks, then none of us should actually be bothering, because the only opportunity out there is to earn perfectly risk-adjusted returns. Clearly, that's not how the real world works. In a volatile market, the tools used by traders are especially valuable for investors. Successful traders don't just mindlessly buy the dip, they watch for key support levels. This can take the form of moving averages, for example, a commonly quoted tool. If you draw something like a 200-day moving average onto a share price chart, you'll be amazed at how interesting the outcome looks. No, it's not a perfect system. No, it's not a perfect approach that the stock will always bounce off that level and then go higher. I'm not going to try and teach you technical analysis in 2 minutes, nor do I profess to be anything other than a novice in this fascinating area of finance. But the point I make is that when you're trying to find success in a market where everything is not behaving itself and going up, it would be really silly not to learn from the masters of making money in any kind of market, the traders. And before the traders get too smug, I must remind you that if a business model is fundamentally broken, then support levels are also not going to hold. There will be enough selling pressure to crash the price right through these levels. And this is exactly why I advocate the use of as many tools in your toolbox as possible when you're trying to navigate hostile markets, whether they are scare or bear in nature. There's no such thing as an opportunity without risk, and these are merely my opinions on the stocks covered herein. Make sure that you do your own research, form your own views on the market when doing anything in your portfolio. Nothing in supernatural stocks should be taken as advice.